probably hear a little bit here. And so that way we can make this available. So anyone who wants to review it again later can. We'll post it to our website. I'm Kevin White with Deschutes Title, the state manager for Deschutes Title. As we were just talking, we changed our name about a year ago from Deschutes County Title to Deschutes Title because we grew outside the bounds of Deschutes County and bought a company over in St. Helens and Columbia County. So we are growing, but we are also the only local family-owned title company in Central Oregon. So we're very proud of that, being local. And so we appreciate everyone who supports local businesses and supports us. So with that, we have today kind of an interesting topic, one that we haven't done in the past, and that is on homeowners insurance. And so I'm very excited for this topic. I think it's something that we oftentimes kind of overlook sometimes. And so I think it's one of those things that we'll pick up some good tips and tricks on making sure our closings go a little smoother with regards to homeowners insurance and what we can do there. I will introduce our panelists today. We have with us Scott Sherborne with Payne West, and we also have Ann Dos Passos with also everyone's with Payne West, and then James Fleming as well. So they're going to be our panelists today and discuss this topic. So I'm going to turn it over to them and let you all kind of take it from there. So I think Scott, you're kicking it off. So I'll turn it over to you, Scott.
Thank you very much, Kevin, for the nice introduction and welcome. Yeah, a lot of you are probably thinking to yourselves, homeowners insurance, don't we just email a binder request over and within 30 minutes of closing everything works out perfectly? I hope that's been the case for most of you, but this class really originated, or the genesis of this class really started about 28 years ago when I first came into the insurance industry. A good friend of mine who was a real estate agent in town here in Southern Oregon came to me and said, Scott, I've had a couple closings now just blow up because of flood insurance requests that were made, and isn't there a way that we can pre-qualify or at least determine before we go to closing what the qualifications are for the home insurance? And for the last probably, I'd say 25 years, requesting binders has gone fairly smoothly. There hasn't really been major issues, but unfortunately, with kind of the catastrophic wildfires we've had here in Southern Oregon, Central Oregon, and then an underwriting climate that's deteriorated, and a reinsurance market that is getting harder and harder to place reinsurance with, has really created kind of a perfect storm to when it comes to getting the home insurance. So our topic today is going to really help you kind of determine or pre-qualify the insurance. But before we get started, I'll give a little introduction. I'd like to introduce the people that do the heavy lifting for us in Bend, Oregon and Central Oregon, and that's Ann and James. My name again is Scott Sherborne. I started 30 years ago in insurance with an Allstate insurance agency. My father was an Allstate agent. I sold the agency about 16 years ago and joined Western States, who became Payne West, who is now, as you can see at the bottom there, part of the Marsh McLennan family. And so grew up in Southern Oregon. I have a daughter I picked up on Tuesday from Oregon State, and a son who's going to be a senior in high school here at South Medford. I live in beautiful Jacksonville. It's a wonderful place. So any of you who have had the opportunity to travel down here and attend Bread or do any of the wonderful wine tasting, you have a new host. So feel free to reach out to me after this webinar. I'd be happy to show off Southern Oregon. But I'll turn it over to the more important people here on this call, and that's Ann and James, for them to introduce themselves as well.
Go ahead, Ann.
Hi, everyone. I'm Ann. My last name is pronounced Dos Passos. I have been in the Bend community since 1999, owned a business, and then I worked for a sports agent and traveled around the globe, and I got grounded and we were all stuck, right? COVID. Who wants to remember COVID? You can use your little hand raise button if you want. I had a friend say, hey, you should get into insurance. And then I met James Fleming. We used to work for a direct carrier in town, which means that we represented that single company. And now we work for Payne West, which is a brokerage. So we can shop for our clients' insurance. And we're really here just for that client service. I know today we will not be talking anymore about Payne West, but James saw me kind of hanging out at a networking event and he's like, you got to come over to Payne West. And then I guess everything just sort of wrote the tale from there. But we have a great office, we have a great team, and we have a lot of fun over here. And I hope that this class really illustrates. I know that Scott has said that he originated this class a long time ago, but just like all of you, we've had giant changes in our industry. And really what we want to illustrate here today for you is the type of market that we're in, any insurance agent is in, all the insurance companies are in, and how we can work better as part of your team to help these closings go a lot smoother.
Awesome. Yeah, and I'm James Fleming. I've been I've lived in Bend since 2000, so which seems like an eternity ago. I've been in the insurance industry for 11 years. You know, I had a previous life with Country Financial for 10 years. I owned my own agency there. And you guys have probably seen my ugly mug around town. But about 5 years ago, I want to say, Mr. Sherborne, he was headhunting me pretty hard and hid outside my house and sneaked through my window and got me to drink the Kool-Aid a couple years ago. So and it was a really good decision to a really great company. So but yeah, I've about 11 to almost 12 years of insurance experience and know Central Oregon very well. And I love the insurance industry. But yeah, there's, like Ann was saying, there's a lot of changes and a lot of things that we're not used to, and hopefully we can shed some light on that in the call today. And yeah, no personal life, I guess I have almost a 1.5-year-old son, and he is awesome, and awesome wife, and just living the white picket fence, son, wife, labradoodle life in Bend. So
Thanks so much, James. Appreciate it, Ann, too, as well. So, well, let's get started today. We're the title of the course, as you guys have seen already, is "Don't Let Insurance Crash Your Closing." The goals of this class is really kind of help you determine why insurance pre-qualification is becoming more important. It always has been, but now with the key changes in underwriting and eligibility requirements are changing. It's getting harder and harder. Just to kind of kick off the conversation with a local event, we had a home in Madras, Oregon that we were quoting. Fairly rural property, but was a wonderful, I felt, risk. And in my 30 years, I know that we would have had every insurance company out there wanting this piece of property. It was had great defendable space. The homeowner was a volunteer firefighter in the Madras community. Had all alternative water sources, meaning that they had water sources they could use to help mitigate a wildfire if it was a hit. Just about 5 years ago, like I said, we would have had every insurance company wanting that particular risk. We went to market just recently, and we were only able to secure indications or quotes from 2 insurance companies. And that's really speaking to what we're going to talk about today, that maybe you didn't think about pre-qualifying for insurance in the past because it never came up. But now it's becoming more of a factor in insurance procurement. What are some of the factors that increase and decrease home insurance rates? What can I tell you? Some tips and tricks, I try to get that out, that can help decrease the insurance, and what may factor as far as increasing it. And then basically, what are the different types of policies out there? Endorsements are a technical term that we use that add additional coverage to the basic homeowners. And most people think homeowners insurance, covers everything like flood, earthquake. It doesn't include flood and earthquake, and that's not endorsement. That's actually a separate policy. But the common endorsements we're seeing now are increases to jewelry, maybe insuring mountain bikes or skis. Other common ones, vacation rental by owners. Some people are renting their homes out, and so you have to have a certain type of endorsement for that. We'll also talk about the limits of insurance and how that factors into what we call replacement cost. And then there's also some coverages that most people don't realize are not covered. And we talked a little about that on the earthquake and flood. I'm going to jump here. Usually this is a live class, so I can look at Ann and James and say any other things I'm missing. So Ann and James, please jump in when you feel appropriate there. So what's going on in the market? Why is pre-qualification important? Right now, the insurance companies, I'm going to show you a slide after this, are having raised combined ratios. And what combined ratios are is that is the amount that they're paying out on claims. And what we're seeing right now, if you look at a combined ratio, $1 is a break-even point. If you have a 90% combined ratio, you're basically making 10 cents on every dollar the insurance company is, just from the underwriting criteria. If you have a combined ratio over that, for example, 120, you're basically losing 20 cents on every dollar. So I'll show you a slide here that illustrates what we're seeing in the current marketplace with the insurance companies as it relates to combined ratios. And those combined ratios are affected really by, you know, the severity, and then also the frequency of claims. And that's what we're really seeing right now is the both severity and frequency is really driving those combined insurance rates. Reinsurance, for those of you who don't know, if you are not public, if you're not a mutual insurance company like State Farm, if you're a larger insurance company, you have to buy what's called reinsurance. Reinsurance basically covers claims over a certain threshold. So an insurance company who says we're going to be on the hook for 20 million, and we're going to buy reinsurance for 80 million, or in excess of what we need to make sure that if we had a catastrophic loss, it's covered. The reinsurance market, which is primarily in Europe, Lloyd, some of you may be familiar with the name Lloyd's London. They basically are the premier reinsurer. Just about 10 years ago, there was about 25 reinsurers in the marketplace. Because of the unprofitability market and rising claims, there's only about 3 or 4 reinsurers. And just like the housing market, the less reinsurers, the higher the premiums are for these insurance companies. And so what they are doing is buying this reinsurance and then passing, of course the cost down to us, the homeowners. Right now, two investors, because of the combined ratios increasing, aren't willing to invest in insurance companies like they have in the past. Sure, there's been a lot of investment in insure tech and claims and data, but when it comes to the actual performance of insurance companies, investors simply aren't buying the stock for these publicly traded companies, and that's obviously affecting the profitability and the health of insurance companies. And then really right now, underwriting is becoming highly sophisticated to wildfires. Unfortunately, I think many of you are familiar with the wildfire mapping that came out just a few months ago. That's impacting, you know, the rating and availability of insurance. So let me show you this next slide. This is just it's a busy slide, and I apologize for the sake of the presentation, but if you go to the far right column, what you will see is that combined ratio. And there's only really 2 companies out there right now that are driving a good combined ratio, and that's Progressive and an insurance company called Century, which I think many of us aren't familiar with. But you can see those combined ratios have all gone up quite a bit and are maintaining high. It also shows you the size of the insurance companies. Obviously, the size of the insurance company is going to impact their combined ratio as well. But that is one of the reasons why we're seeing this increase in the limit of the market. Speaking of the limit of the market, we've had 2 insurance companies in the state of Oregon, Oregon Mutual and Main Street America, which aren't major insurance companies, but they've completely withdrew from the Oregon marketplace. And that's a concern of ours. We like the increased competition, and typically that competition drives price downward. But unfortunately, we've seen 2 companies that have been unable to maintain a profitable status, and so they have withdrawn. The biggest news I think many of us saw just a few weeks ago, State Farm is no longer going to be writing home insurance or property insurance in the state of California. That is concerning because they do take quite a bit of that risk on, and it's unfortunate to see that's going on. You can see right there the losses that we're seeing in industry, pretty significant hits, and because of that, again, insurance companies aren't willing to insure in certain locations, or in this case, as we saw in California, in certain states. And by the way, if there's any questions, please feel free. I don't want to monologue here for you guys. And on Zoom calls, it's easy for you to get somebody up here just to talk without questions. But please send a chat out there. I know James and Ann will remind me that we've got some questions out there too. So we talked about pre-qualification. It's something I know that you as a real estate agent do. You want to make sure you have a pre-qualified buyer, and then so they go out and get their loan, or at least have some pre-qualification letter. What we're really encouraging to do is to avoid the homeowner's policy crashing at closing, is to identify some of the characteristics that go into, or factors that go into determining the premium. So one of them is making sure that we are able to run a credit score. Our credit score is a soft score. It doesn't affect the eligibility of the individual. But it is something that factors into insurance. And when I mention these factors, we're going to talk about location, we're going to talk about a clue report, we're going to talk about insurance scoring. keep in mind that not one of these factors has a significant impact. It's when we have a combination or a perfect storm, when we have maybe a low insurance score, we've got a rural property, they've got 4 or 5 claims that were opened in the last 5 years. That's when we get in trouble, and that's why the pre-qualification becomes more and more important. In the Madras example, that was in a situation where the wildfire mapping really limited that individual's opportunity for insurance. So I would say if there's anything that kind of jumps out, if you have a rural property and you're going to market, please, please, please take the time to call any insurance agent and make sure that that property is securable. And keep in mind too, the difference between a quote, a binder, and a policy is vast. What I mean by that is if you get a quote, that is all it is. It's just an indication that if it meets the criteria that we're going to talk about on today's call, it would be eligible for the rate proposed. When the insurance company issues that binder, it's saying, okay, this coverage is bound for a period of 30 to 60 days, depending on the insurance company, so they can finish the underwriting. During that underwriting stage, you can get a binder and go to closing. The house is done, everything's been put to bed, so to speak. And then all of a sudden, you get a notice from the insurance company that upon the inspection, they found maybe moss on the roof. They saw maybe a crack in the foundation. They saw some conditions that they are now revoking that binder, and now that property is uninsurable. And now you've got to go back out to market to find an insurance company that will take that particular risk. So you can avoid all those pitfalls by doing the pre-qualification. Typically, pre-qualification for insurance, we can usually get a pretty good indication of the risk within 72 hours. Ann and James will send after the class. We have kind of 6 things that kind of look a little checklist that you can look at that can help you kind of identify, okay, do I have a situation here that may end up, coming back to affect us at closing or after we've closed? James, Ann?
I was going to say one thing real quick. I mean, you probably heard it from, your neighbors or your friends or something when you guys talk shop and they're like, oh, how much are you paying for insurance? So I'm paying $1,000. And then my neighbor's like, well, I'm only paying $500. And you're thinking, oh, well, I should be paying $500 too. But it's all those factors that are put in the algorithm that determines your quote and your rate and everything like that. And so whenever, I have, people ask what a spitball premium would be. I'm like, it could be anything, honestly, based on all these different factors. I mean, it's probably similar to somebody saying, oh, Zillow has this house for 1.2 million. Why are you saying that's, it's exactly the same thing. There's so much that goes into it. So.
No, that's a great point. One of the obvious things is location. I think I skipped over one quick here. Oh, no, I didn't. Is the location. And so one of the things that any insurance agent can do prior to closing can go and look at that location, determine what zip code and territory that's in, determine whether or not it is in a wildfire area. It's kind of interesting. I live in Jacksonville. I'm literally on the actual right at the city lines. So I'm the farthest from the core of the mountains. If any of you've been to Jacksonville, I'm one of the first streets you encounter when you come into Jacksonville. I, like you, felt my home insurance was a little expensive. So I had one of my colleagues see if I could get a better rate. And unfortunately, when we went to market, the 15 different companies we looked at, only 5 would even offer insurance. And most of the quotes that I received were higher than what I was currently paying. And that's something that's really important to you as a consumer. For those of you who have home insurance right now, if you do get a quote in the mail or you get an opportunity to save money, one thing we would recommend you do is tell the person, hey, great, that looks like a great rate. I want to be effective, in 60 or 90 days. The reason why, if anything does come up, you can get that quote to actually be the actual policy. I'm telling people, do not switch on quotes right now. The market's just too vulnerable right now. So make sure that if you are planning on switching insurance, tell the insurance professional you're working with to make the policy future effective. You will get a better discount. Insurance companies like the opportunity to look at risk prior. They don't like issuing binders the same day or within 24 hours. So if you are shopping for insurance, please don't shop or switch on a quote. It doesn't guarantee the rate. Tell them you would like the policy to be effective 60 and 90 days in the future. Then when you get that actual policy, then you can compare the coverages and the rates to make sure they're there. One of the things that we see is water source in rural locations. The market's changed a little bit. A few years ago, we had a property in Madras, Oregon. The individual had a large pond, water reserve, and he also had a pump that could pump so much water per minute. And we were able to take what we considered really a high-risk area and reduce the premium significantly by making those indications. We're not seeing that as much now. I mentioned the example at the beginning of the call. It's not quite as common, but one of the things we look at, or not we, but any insurance company looks at, is what we call the protection class. And what a protection class is, it's an assessment on a fire district or fire community, firefighting community. 10 being the worst would be your F student. Your A student would be a PC or protection class 2. We can look at that information prior to closing, determine, tell you, okay, you're in a protection class, 3. That's going to be cheaper than a protection class, let's say, for example, 7. If there are insurance companies out there that will consider alternative water sources, we can definitely have that conversation prior to closing to make sure that we can take advantage of the alternative water source and lower the protection class. In the Madras example with the pond and the pump, we went from a protection class 10 down to a protection class 6, and that was a significant savings for that particular individual. One of the things you might do as a real estate agent too is really the access to the home. If you see that this is a narrow road, fire trucks cannot turn around or respond to property, when they do the visual inspection, which takes place after the policy quote or binder has been issued, this could come up. It's probably one of the more common things that comes up, that we find out that particular property has poor access to the residents, and because of that, they will then cancel that policy. And they can cancel that policy mid-term. They do have to let the homeowner notify. In the state of Oregon, has to be up to 30 days notification that they're going to non-renew, but it can happen. And James, anything I'm missing on location?
We have a couple of hot spots in Bend right now. You might be surprised. So
No pun intended, right?
What's that?
No pun intended.
Yeah.
I know. What was that one name we had the other day? I mean, Madras right now, we have some challenges right now. Sun River. Sisters. Okay.
Sisters. Sun River is doing pretty well, but we do have some areas for the Deschutes County zone that Northwest Crossing is getting a little touchy. So the sooner you can get it out to your agent, the quicker you'll know if you need to keep moving.
West side of Bend, I notice a lot of the companies that we go to that aren't local or Northwest companies, they see like the mountains and the forest on the west side, and it's sometimes just an automatic decline. So that's what we're seeing right now. And so, yeah, and especially, and you guys know definitely, how expensive Bend's getting to. So we're seeing a lot of Madras, Prineville, Sun River, Lapine close to, and some of those can be pretty tricky just because, especially if it's, my favorite, if it's a manufactured home built in, 1950 or 1960 or something in between, Lapine and Sun River. I mean, those are the ones that we really have. Everybody has trouble trying to place right now. So,
thanks, James. Thanks, Ann. Go here to our next slide here. So we talked a little bit about the protection class code on the prior slide, but one of the things we're seeing is, where is that nearest fire station? And does that, if there's not one, is there a subscription available here in Southern Oregon? In the community of Grants Pass, we have some fire departments that have agreed to sell subscriptions to individuals that might be outside the typical response time. A lot of people think that fire hydrants factor into insurance. Matter of fact, I have a funny story. In my prior life, I had an individual that was year after year was winning all these awards. And back when I started insurance, we had a thing called Polaroid. So those of you who are in my age realm, you probably remember those. For the younger people, it's a camera that you would take and it would make this really cool noise, and out would pop this really bad picture, and you'd wave it in the air and it'd dry, and you'd have a photograph. Well, we were required at that time to go out and take pictures of properties and submit the Polaroid picture with our written applications. This is before the computers. You had to mail it in. And this one individual every year up in McMinnville, Oregon, would dominate that he would sell more home insurance than anyone else. Well, like most, they started looking into it a little bit deeper and saying, okay, why is he selling so much when everybody else isn't? Well, come to find out, in every single photo, he had this fire hydrant. He had actually went out and purchased a styrofoam yellow fire hydrant and was placing it in front of every home to get the lower rate for his homeowners. Well, they caught on, and he's no longer with us. I think he's maybe selling Polaroids today. But anyways, it was kind of a unique, funny story. But making sure you know where that fire department is really critically important. You can look on Google Earth or Google Map and see where that's at, but just making sure that there is a protection class. Another interesting solution that a homeowners association came up with here in Southern Oregon. We have a property south of Lake of the Woods. For those of you who come down or come over to swim there, there's a small community there of homes just outside of Lake of the Woods, and they actually put together their own volunteer fire department, and that was able to secure insurance in that particular location. I wouldn't buy a home and try to build a fire department around it and a rural property, but there are some solutions out there when there isn't a typical response time as well. So clue, many of you might not know what a clue is. A clue report, and in simplest definition, would be like a motor vehicle report when you apply for auto insurance. You run the motor vehicle report to see if there had been any claims, or excuse me, tickets or accidents in the last 5 years. The clue report is that for home insurance. What the clue report does is, as it looks at, was there any claims or prior claims that have been submitted in the last 5 years. The clue report is pulled in Oregon on the individual applying, and that's so important. If you're representing a buyer or buyers, keep in mind that if there are multiple buyers that have formed maybe an LLC or to buy a property, or it's a vacation property where there's mutual owners, a clue report will be run on each individual who's buying or applying for that loan. And that's true of every insurance company in the state of Oregon. In other states, for example, Texas, the clue reports are ran on the property and used in underwriting on the property side, not the individual side. But in Oregon, those clue reports are run on the individual. And it's kind of like Shawshank Redemption when they asked them, Andy asked him, are you in here? Everyone's innocent. Everyone forgets about their driving records and their clue reports. So it's one of those important things you can do. We'll show you a slide here. You can get clue reports from any insurance agent. You can also get them online from Nexus. We'll show you that website. But that's probably one of the most important things that individuals, when it comes to pre-qualification, aren't aware of, that clue report will pull up. The claims that they look like, there's a different factor for most insurance companies on what type of claims come up in the last 5 years. If it's a theft claim and there's multiple theft claims, the underwriting will be a little bit more rigid with someone maybe who had an accidental water loss in the last 5 years. Now, if there's a frequency issue or there's multiple claims, that can affect eligibility. It will certainly affect the price of what they pay for the insurance. One of the good news is in the state of Oregon, the Oregon Insurance Commissioner has told insurance companies that if there is a claim that is large enough where the insurance commissioner says it's a catastrophic loss, for example, here in Southern Oregon, we had the Alameda fires. Those claims that were submitted during the Alameda fires cannot be used against an individual applying for insurance. So there is some forgiveness as it relates to certain types of claims, but remembering what those claims are and how many you have, most people forget. And so it's just a good idea to ask your insurance professional while you're going through this pre-qualification process, hey, can you run that clue report so we can make sure that they are on there. One of the things that's come up, and one of the large insurance companies, I won't mention any names, is now using auto claims or the motor vehicle record to determine home insurance rates. I don't know how they got that past the Oregon State Insurance Commissioner's office, but they did. It was approved by the insurance commissioner. So unfortunately, insurance companies are looking at more data than they ever had to determine rates. One of the scary things that's been proposed, and for those of you who are Big Brother fans or not, one of the things we're proposing is looking at what they call social underwriting or social index underwriting. And what they're doing by this is that they can look at consumers and individuals' buying behaviors. And one of the things that was brought up is if someone like myself belongs to a lot of Southern Oregon wine clubs, they'll say, well, if he belongs to a lot of Southern Oregon wine clubs, he probably does wine tasting more than the other person. So should we use that as a index or a rating factor in determining the rate? Because the likelihood of maybe not driving drunk, but maybe driving with a tasting, he's a more high risk driver than someone who doesn't belong to wine clubs. Pretty scary type of underwriting practices that are being proposed. I don't think that's going to get past the insurance commissioner's office, but it's just interesting how much insurance companies are looking at more and more data. And because, as we know, with the internet and social media and everything else, there's a lot more information out there that they're considering to looking when it comes to determining what people pay for insurance, which is kind of scary there.
Put that
James,
to your lesson
Ann?
too. Don't
Yes.
be careful what you post on social media. That's all.
Yeah. And by the way, for those of you that we talked about coverage, one of the coverage tips is unintentional acts on social media can be covered by the liability portion of a homeowner's policy. Please don't be like one of my clients that lived on the golf course and ended up getting an altercation and called in and said, "Hey, I need to open a claim." I said, "Well, what happened?" "Well, I lost it one day and I ended up striking someone, and now they're suing me for hitting them." Intentional acts are not covered. So by all means, make sure this is unintentional if you're looking for coverage for particular claims. Who has clues? Basically, LexisNexis.com. For those of you who are on the call here, if you write that down, you can go to their website. I believe they allow you to order one clue report per interaction and whatnot, so you can even run your own. Again, you can go to any insurance agent. This is not a, like Ann said at the very beginning call, this is not a Kane West promotional video. This is a CE class. So we want to make sure it's clear that any insurance professional can get that clue report for you. We talked about, is it the person who's applying for the owner or is it the property? It is the owner on there. And again, we talked about LLCs, rental property ownership, multiple owners, making sure that those clue reports are all being ran ahead of time. We'll make sure that closing doesn't crash.
Real quick, I want to mention too with the clue report. I mean, obviously, like, with insurance companies, losing money now, they do. I mean, they specifically rate on like, well, what's the action that loses us money? Well, it's claims. So, with the clue report on home insurance, I mean, one piece of advice I would say is, make sure if you do a home claim, that it's a big home claim. It's worth it. What I see in the market right now with these clue reports coming back, and all of a sudden this person can't get coverage for new home insurance because they have two $1,000 like home claims on like tools theft, or like maybe it was like a minimal water damage and things like that. All those claims, they bump against you, and so I would just say make sure it's like a catastrophic big boy claim. If you do home, it's meant for fires, it's meant for a huge water loss. That's what home insurance is meant for. And so that's what I see a lot of people now. They're like, oh yeah, I did 3 claims in 5 years. Well, now their insurance is usually really, really expensive now, or they can't get it. So.
No, that's a great point. That's actually points to my slide here. This is an actual clue report. It's a little outdated, so I'll need to probably pull up a newer one for the next presentation. You can see here was a $3,158 claim. And to James' point, as an insurance professional, I'm like, where was that agent in the pre-consult of the claim? What type of advice were they giving them? And like James said, frequency actually has more impact on claims. So multiple claims coming up on clue report is much worse than 1 or 2 larger claims. If it's a cat claim like Alameda, it'll come up on a clue report as a cat and cannot be used against the individual for insurance. Another thing, that just some coverage advice for you folks, if you want, homeowners policies are so different. Every insurance company has 3 to 4 different types of homeowner policies. So James's conversation earlier about comparing your neighbor's insurance, most people rush in the closing. They get their binder and they never even look at the insurance. You can customize your insurance. I think Liberty talks about that. You really can customize your insurance. And I see a lot of individuals now that are treating their homeowner policy as a catastrophic policy. And what I mean by that is they're going with a $10,000, $25,000, $50,000 deductible for the losses, the large losses. And the large losses, statistically speaking, are 1 every 8 years. So that's like the fire, the theft, the wind, the hail, those type of losses. One thing you can do is, not only with that deductible lower the premium. With many insurance companies, if you have a higher deductible and the claim goes over that deductible amount, they will erase or remove that deductible, so you have first dollar coverage. So the insurance companies will do that for you. What we also do advise is you can go in and schedule personal property. And what scheduling personal property means is that you are taking out a separate policy or an endorsement on a particular item. For example, I love mountain biking. I just bought a new mountain bike, and for those of you who probably do mountain bike, mountain bikes are not cheap. They are very expensive, and I've elected to insure that mountain bike. By doing so, if it's stolen, if it falls off the rack and is damaged, if there's a mysterious disappearance, meaning I parked it somewhere and I don't know where it's at, not only is it covered, it's typically going to be covered with a low deductible, and that particular claim will not impact the clue report. Scheduled personal property, or what we call blanket insurance for certain items. What you're doing is you're buying back coverages for maybe items like jewelry, guns, collectibles, those type of things. If you buy a separate policy for them, that won't come up on a clue report. So there's a lot of ways you can kind of mitigate the policy crashing and closing with doing that type of structuring or customization of your own insurance.
A quick question, Scott and James, on that is if there are claims like on a homeowner's policy, does it follow the home or just the individual? So if they sell that home, does it still affect that home?
Great question, Kevin. In the state of Oregon, it's the individual. Now, James, correct me if I'm wrong, because I'm not selling insurance every day. As a director, you're starting to see some insurance companies that are doing it differently?
No, if it's sometimes a past owner claim will show up on like a new home purchase, for instance, but that's easy. That's an easy call to the underwriter to override that. So,
but to answer your question, it's the individual, and that's why, like I said, if you have an investment property or multiple owners, running that clue report to see, what all the owners have is critically important, and often, a surprise at closing. I guess they get the binder and all of a sudden it's gone up, or they're saying, "Oh, we can't insure you." Well, they finally ran the clue report and found out that because there's 4 owners, one of the 4 have 4, frequency claims. That one person can really drag down or eliminate the coverage for that particular situation.
Right. And then, claims on if you have multiple rentals and things like that, and you have multiple claims on multiple rentals, that really affects it too, because it does follow the individual.
Yeah. One of the factors is the age of home. So we talked about earlier, what can make rates be more expensive, less expensive. Older homes are going to be typically more expensive to insure, just because of some of the conditions, and the way they're built. It's really important that when you put together a homeowner policy for an older home, that you include coverages like law and ordinance. Law and ordinance gives the individual coverage or additional coverage for building code improvements. If you have a partial fire, and I've had this happen with clients, like in a kitchen only, that particular damage has to be rebuilt to code. And obviously with that home being older, it probably wasn't up to code, and that can get very expensive. And there are certain limits for certain homeowner policies for that building code coverage. So it's really important that when you're talking to an individual that has an older home, that they're aware that these additional coverages exist. There's also coverages now for damage. And when I started selling insurance back in 30 years ago, pretty much home insurance was fire, lightning, smoke, vandalism, and was only limited to the foundation of the home. Now you can buy coverage for the water main from the house to the street. So you've got an older home. If that water main hasn't been replaced in many, many years, it can be insured. It has to be a covered cause of loss, but those are things that can come up for individuals. And we can help, determine, any insurance agent can help determine there. Another thing that comes up too is renovations to the home. Full roof replacement will lower the rates if it's done within the last 5 years. Full electrical will be considered, can be lowered, and full plumbing. I had an individual here in Southern Oregon that bought a home in the 50s, went through and completely renovated the home. He had a wonderful binder full of all the receipts. I submitted that to an insurance company, and they actually took the original age of home, which would have been very expensive insurance, and it would reduced it. Matter of fact, the applicant of the home insurance policy called me and said, why are you $800 less than everybody else? Is because we were able to find an insurance company that took in the renovations, and they changed the effective date to the date that all the renovations were done. But it was a very, very extensive review. But that's something in that pre-qualification stage we can look at. Maybe, for example, you've negotiated as a real estate agent that the roof will be replaced at the point of purchase or shortly after. That's money on the table as relates to home insurance. And so just something to be thinking about when you're working with individuals. I think I see it.
We have a
Yeah.
couple of questions, Scott.
Yeah, go ahead.
How does age of roof affect the home?
You got that one, Ann, and I'll jump in too. Yeah.
When James and I or any insurance agent are going through and establishing your quote, there's actually a spot on the application asking, obviously, when was the home built, the total square footage, and then were there any redos happened? So roof comes into play, obviously. Wiring comes into play on older homes. And then the second question, James, maybe you want to take it. Are there breaks at particular calendar years for age of home considerations?
Every company has their own algorithm on, it's kind of a sliding scale as far as that goes. Obviously, the difference between a home built in 1901 versus 2005 is going to be pretty different depending on like the renovations and stuff over the years. But usually, and Scott, you can correct me if I'm wrong, usually like 20-30 years, you get pretty decent raise, but then past that it kind of goes down on a sliding scale. So
yeah, that's true, James. And one thing that we're seeing too in the marketplace, and for those of you who currently have home insurance, make sure you look at your policy and determine, does the age of roof impact the claims? We're seeing a lot of insurance companies saying that after a 20-year period, if the roof hasn't been replaced, the coverage would go from replacement cost to actual cash value. The best way to explain that is, replacement cost is you going into Nordstrom's and buying a brand new suit. Actual cash value is you getting that suit at a garage sale. It's a vastly different calculation for that settlement. And there's one particular insurance company I was looking at the other day actually has buried in that wonderful policy that we always read when it comes up for renewal, if you get one, if it's not emailed to you. One of the pages shows a schedule of depreciation for roofs, and it starts in year 6, and they basically pay less of the roof replacement based on the age of that roof. So for example, if that roof is 18 years old, they will factor in and subtract a percentage of that replacement cost. So for example, if you have an 18-year-old roof and it costs $20,000 to replace it, some insurance companies will say, we're only going to pay 60% of that because of the wind claim that you're submitted, because there's wind damage. Sometimes too, some insurance companies will limit that coverage only to the damaged area if it's an older roof. So if you're representing homeowners where the roof is old, by getting a new roof, it's not only going to impact their eligibility, it's going to lower their rates, and they're going to get a better claim experience on newer roofs.
And it's full plumbing, full electrical. They won't take partials. And then something else to think about, if you yourself or your client is buying in one of the original neighborhoods in Bend, our water lines are galvanized here and they're blowing at a quick rate. So I would definitely suggest maximum bury the utility lines for them. And then if you've got a rental, water seepage and leakage is probably our largest claim that we see on the insurance side. And that's basically like, I've got a refrigerator in my rental property that's got water, ice hookup, and it's been seeping and we didn't know about it. And then all of a sudden your wood floor is warping. If you don't have water seepage and leakage, then you won't have coverage.
And think of it this way too. I think Annie made a good point. The terminology insurance companies use for claim determination is it sudden and accidental. And that's the first kind of microscope that they look at when determining, is it a covered cause of loss, and was it sudden and accidental? If it's not sudden and accidental, we mentioned the word, that's where endorsements come in. You can actually buy back some of these coverages there to get those, as Ann just mentioned. So that was a good point, Ann. This is normally we'd take a break, but I think we're going pretty good. We're at 9:44, so we'll keep moving along here too. So a lot of people say, well, you know what, Scott, how buyer inspection? I've got the inspection here, and the inspection for the buyer or seller, whoever put that together, was perfect. What's up with the inspection on insurance? What's different? Well, the big differences are when they go out and look at the insurance inspection, they're not looking at they're looking at insurability and for the sake of the insurance company. So they're going to be looking at, like we mentioned earlier, is there moss on the roof? Are there overhanging trees? Are there cracks in the foundation? I had a situation a few years ago where they weren't going to insure the home because the spacing between the patio deck was too large. It wasn't narrow enough, and so they literally had to go through and replace every board around the perimeter of the deck. I had a situation where if the pool, swimming pool, isn't fully fenced, they rejected the coverage. So there's all kinds of things that they're looking at that are different. Is there a trampoline? Trampolines were for a while a really big factor. So they look at a lot of different things that you're not going to have on a typical buyer report. Are there animals on the property? And if so, what type of animals are they? Dogs used to be a big issue when I first started. Many of the insurance companies now are opening up their dog list as far as, but keep in mind, dog bites are covered by the bodily injury portion of the policy, and that would be something that would come up on a clue report if there was a dog bite in the last few and how much was paid. They're going to look at that. They're also going to look at the frequency of that animal. Are we seeing 3 or 4 claims? If they are, then obviously that'll be a factor as well. But the inspection that the insurance company does is different. It's for the benefit of the insurance company, not the homeowner. They're there to determine whether or not there's particular conditions that may make that property a difficult place to insure and then have multiple claims. That's here for you. So how much insurance is the right amount? It's not a big issue now, but what we typically get when we get a binder request is amount to cover the loan. And we can be very creative with that. Insurance agencies have by the structure of what we call additional insurance. But keep in mind, the insurance policy is there to insure the property, to rebuild the home at the time of a loss. So many times we'll see, requests in the marketplace to cover the purchase price and or the loan amount. What insurance companies do is they run what's called a replacement cost estimator. That estimator can be done really, really well, or can be done very poorly. If you're rushing to get that binder and you got to get that over to the title office within 24 hours, they probably didn't take the time to really go through. Now, a lot of that information is public. Yeah, you can go to Jackson County Assessor's page. You can go to Zillow. You can get some of that information, but really determining the quality of the cabinets, the quality of the hardwood floors, what makes that home unique, it takes some time. So if you haven't sat down with your agent and done a replacement cost estimator on your current policy, please do one. With the demand surge that we've experienced and then the supply chain concerns, a lot of properties, I saw stat just the other day, 60% of the homes are underinsured. You do have mechanisms inside the policy that will help. If I'm gonna use really simple math for everybody, if you have a $200,000 home, let's say that's a nice home, typically most policies come with 120% replacement cost. So that means that if there was a catastrophic loss, even though the coverage A or the amount of insurance offered is 200,000, they'd be eligible for 240,000. Maximum. Now, there are policies out there that will pay 150%, and believe it or not, the replacement cost guarantee that was eliminated after the Alameda fires years ago, you couldn't even find guarantee replacement cost, is coming back. And what that means is no matter what it costs to replace the home, as long as the insurance company and the applicant took time to do replacement cost estimator and agreed upon the replacement cost, they have unlimited reserves or unlimited checking account to replace that home. And that's super important. You don't have to visit it every year. You've got that guarantee built in. And keep in mind, most policies that you purchase or have purchased, there is an inflationary portion to that. Rates are going up because of claims activities, but rates do go up from periodically due to inflationary changes as well. I've talked a lot, James, so I'm gonna give you any comments you guys have on that?
I'll give you kind of an analogy of like replacement cost, which we care about as insurance companies versus the market value of your home. Let's say you have like a home on Aubrey Butte, and you have that exact same home, that exact same build in Chemolt. Obviously the market value of those homes are going to be drastically different, but it's going to cost exactly the same to rebuild from the ground up. And that's what the insurance company is worried about, is how much it rebuilds from the ground up, not the value of the land, not the value of where it's at in town or which town it's in, and so that's kind of the biggest misnomer we give from mortgage companies is we just got to match the loan, you know, and it's actually illegal in Oregon to insure the home to way more than what it actually is insured for. We got like a letter from the governor. I think it's still the letter saved on my computer, but so the mortgage companies have been a lot better about that nowadays with the replacement cost estimator, and the extended replacement cost endorsements have been able to help mitigate that too. So but that's kind of the difference between market value and replacement costs.
Thanks, James. That's a good point. Sorry guys, I moved my cursor over there. There we go. We talked a little about this earlier, but in Oregon, you can't insure something you don't own. I had a client of mine call the other day and said, "Hey, I'm borrowing my brother's jet skis. Does my homeowner's policy protect me on that?" And unless you sell the jet skis and take out a policy, there really isn't any coverage. There is coverage for temporary use of items as an extension of the homeowner's policy, but if you in Oregon, you can't insure something you don't own. So we have to make sure that not only do you have insurable interest, but who owns the property? Is it one person, is it individual, is it LLC? Those are key issues on that. Why do we need to know? Again, determine that insurable interest. I did have a story that happened, true story. One of them, a client that I had in prior life, had a home paid off, free and clear, decided to move his girlfriend in and take his ex-wife off the insurance contract and put in the name of the girlfriend on the deed. It was in process at the time, so it wasn't fully recorded. And I think these days these things would be caught a lot quicker, but they had a total loss. The home caught on fire. They came in to submit the claim. The adjuster said, "Okay, well, who's this person? We have a policy for the Mr. and Mrs., but we don't have a policy for the girlfriend. Does the girlfriend have her own insurance policy?" "No, I thought she was covered on the homeowner's policy." And they said, "No, you don't have any insurable interest." And so make a long story short, it went to trial, and the jury and the judge decided on the side of the insurance company that the insurable interest was not there at the time of loss, and there wouldn't be coverage. And that's something that a lot of people don't realize too. Insurable interest has to be at the time of the loss for property insurance. And so that's really important to remember. If you do some changing of ownership through, be sure to call the insurance company and add that additional owner to the policy if something like happens. And be honest with your ex. Flood zones. This is probably the biggest item that can come up to close a crashing or cause a closing the crash is they didn't know there was a flood zone. Even though we've run flood determination, all of a sudden there's a flood requirement. We can pre-qualify the policy for that. Flood insurance has been hard to get. The federal government last year, there was a period where there was no flood insurance offered through FEMA. There has been an emergence of an independent flood market, and more lenders are accepting non-FEMA flood insurance. Typical FEMA flood insurance only gives coverage up to $250,000. That means we have to go get excess elsewhere. You can't assume current flood policies. That's sometimes been brought up in pre-qualification. Well, we have flood insurance right now. Well, that flood insurance may be for a refinance. I see that happen a lot of times when people go to refinance. The property was not in a flood zone, and now it is in a flood zone. And they went out and got flood insurance just for the portion of the loan, which scares me to death because the home should be insured value, and who knows what that future loss could look like. There are some things with flood insurance. You can do what's called a letter of map amendment, LOMA. And what that is you have a surveyor go out and actually do a updated survey. And in some cases, those zones have changed enough where they're no longer in the floodplain zone and the flood requirement can be removed. That is not something that can be done within 24 hours, but can be part of your pre-qualification process. So if you think the property may be in a floodplain zone or may need an elevation certificate done to determine if it's in one, it's something you can come up with. Keep in mind, flood insurance, earthquake, landslide is not covered on a homeowner's policy. These are separate policies that need to be purchased. Just some consumer FYI, if you have earthquake insurance, you will not be eligible for any federal assistance. If you're without earthquake insurance, you would be eligible for the federal assistance. It comes in many shapes and forms when it comes to that federal assistance. We saw it here with Alameda fires. It wasn't a smooth process at all. So if you have a homeowner that is coming on a cash offer or has a lot of equity, I think it's really, really important to consider earthquake insurance in Oregon. It's still fairly reasonable. And I think all of us know that there's a fault line north of Astoria that is overdue for an earthquake. And then from time to time, we've felt some of those. Keep in mind too, when an earthquake does occur, almost every insurance company will put a mandatory they will not offer earthquake insurance typically for a 72-hour period. So it's not one of those things you can call. One of the things that you can write down and just have the peace of mind that if a fire results after the earthquake, the homeowner's policy in most cases will respond and pay the claim underneath the fire portion of it. I did have a client that called me up when we talk about earth movement. That is not a covered cause of loss. We have an area down here in Southern Oregon called Hillcrest. If you've ever been up on the hill, beautiful views, but we have this horrible dirt called black sticky, and the black sticky really does not make for a good foundation. And a lot of the homes up there had some settling, cracking, bulging. One of my clients called and said, "Hey, I need to open a claim. The foundation is shifted." And I said, "Sorry, it's not sudden accidental. It's not something covered on a typical homeowner's policy." And like most people, in frustration, said, "Well, and what the heck is covered?" And I said, fire, lightning, smoke, vandalism, theft. Make a long story short, just a few weeks later, guess who had a fire loss? Within other few months later, someone is serving time in a federal prison for insurance fraud. So don't misrepresent the policy or open those type of claims. It's not a fun experience. There is a good experience if you buy a policy called difference in conditions. This is a rarely purchased policy. What difference in conditions will offer both flood, earthquake, and earth movement coverage. It's fairly expensive, and if you're only concerned about earthquake, I wouldn't purchase the difference in conditions policy, but it would take care of the flood, earthquake, landslide, earth movement situations. It's fairly expensive, but again, if you've got a home where you've got a large amount of equity or the home is paid off, these are really valuable policies and should be considered. If you have a home where you've got mainly a loan, I don't know if you want to, purchase a policy to make sure the home gets rebuilt, for the bank. But a lot of my clients that are elderly purchase, these type of policies to make sure they have that peace of mind. James, Ann, any additional comments there?
You sell a house in Prineville, you probably ran into this with flood insurance. So it's fun stuff, elevation certificates and all sorts of stuff. So definitely want to pre-qualify your client beforehand. That's a flood binder is something you don't want to request at the last minute.
Yeah. And again, there's solutions too. We've saved a lot of deals for individuals by getting elevation certificate, a letter of map amendment. Doesn't guarantee it. There's sometimes I've had surveyors go out and do the elevation certificate, and it's actually in a worse flood condition. People don't realize that we all live in flood zones, even though on a hill. That's a definite flood can occur anywhere, but most likely there are areas where they are higher risk, but very similar to the protection classes we talked about before. Additional pre-qualification support is coming in. I couldn't download the slide because it is 4 pages, but here is one of the insurance companies now that will actually give us a pre-qualification assessment. They'll talk about it pulls all the building permits that were pulled, which is a good conversation to have with your client in pre-qualification. Was this building permit pulled for full electrical or full plumbing? If so, we can get that information to the underwriter and say bring down some of the insurance rates. But Travelers, Safeco, I'm sure State Farm, other companies that I'm not familiar with have some type of additional pre-qualification resources that you can use. I'll have Ann and James email Kevin with the Pure report. You can order those. They don't cost any money. It's just an extra step and some talking points you might go into. They're fairly I wouldn't use the word vague, but they're very general as far as, is this a high, low, or medium? And you've used this a couple times. You want to share your story, how you use them?
Yeah, I've been using them mostly in homes that they've gone into contract and they want to know, the buyer wants to know what they're getting into. So it will show you basically the property's insurance ability. So it's like fire, very high fire zone. So that's when they're really going to need to start shopping. And if you do have clients that are on the income ratio line, that's a great thing to share with your insurance agent, because they can make sure that the client is covered for catastrophic losses like Scott is talking about. and really work to make sure the home's properly insured, that the risk is taken care of and mitigated off to the insurance company, but also watch the dollar line. So, James and I have worked with plenty of clients that have that ratio, and it's a really great thing to get ahead of. We also have the ability to, as Scott has been saying, pre-shop your rates, but in some cases we get discounts for early shopping.
Yep.
So we can set the policy effective date out to the date that you believe you might close. And we can give that a larger window if you need that. And then they get additional discounts. And then they get additional discounts if they bring us their car or if we write them an umbrella. So there are things that it's important the buyer understands if their ratio is very close to what they can afford monthly.
Great point, Ann. One of the things we always encourage, get renter's insurance. It's incredibly inexpensive. A lot of people don't understand rental agreements when they sign them. For example, I had a client of mine that was taking the time to wax her upper lip, put the hot wax on, or put the wax on the oven. It boiled over, damaged the entire kitchen, about $55,000 worth of damage. She did not have renter's insurance. She was in the process of getting ready to buy a home. Shortly after the claim was mitigated by the insurance company for the landlord, they did a really awful word, subrogated. For those who don't know, subrogation is the process where they go after the responsible party, and they put a judgment out on this poor individual who was pre-qualified, now had a $55,000 judgment because the insurance company was coming after her because she was negligent for damaging that particular kitchen. Renter's insurance would cover that type of loss, so it keeps your pre-qualified individuals away from having that type of experience. Renter's insurance gives a discount for the home insurance that carries over for the duration of the home loan. So if you have prior property insurance, including renter insurance, it will lower the home insurance rates. You do have to have the renter's policy, James and correct me if I'm wrong, is it 6 months or 12 months prior to buying a home policy to get that discount? Is that right?
I think so, yeah.
So just as you're talking to folks, if you're doing a new homeowners workshop, have them all raise their hands and ask if they have renter's insurance. Another thing to think about too, if you're like me and you're just picking up your children from college, they are covered on your homeowners policies. The problem with that is typically the average homeowner policy, is going to be anywhere from $800 to $2,000. If you submit a claim for your son or daughter's laptop or mountain bike or whatnot, you will lose the claim-free discount in that policy. It's typically 10 to 20%. So you think about this, you have a $2,000 homeowner policy, it's going to go up, up 20%. You could have a renter's policy for $150 for your college student. If they have a claim, it's on their CLUE report, not yours. It's on a lower premium than your homeowner policy. And the only thing is you can't buy renter's insurance for dormitories. So it's got to be probably that sophomore, junior, senior that is living in an apartment that we're in.
Make them live at home.
They can do that too.
There's
Just
no
some special.
basements here.
What's that, James?
There's no basements in Central Oregon. A whole lot.
Yeah, there you go.
go.
We are coming up, guys, on the hour here, Kevin. So I'll just kind of wrap up with just some special coverages and considerations to think about. Vacation rental by owner, Airbnb. There are companies out there that act like they insure the Hilton, meaning that they're going to cover what you would experience as someone who's professionally involved and constantly renting their home out. There are also very cheap endorsements that don't cover a whole lot. So it's really important that when you're talking to your folks, what are you going to use the home for? If you're able to determine that it is a vacation rental by owner, there are really good insurance companies out there that will give broad coverage and cover things that some don't. And there are other insurance companies that it's a very limited basic, even though just because it says it's a vacation rental by owner endorsement, it's going to have some limits and internal conditions that are going to be a lot different than some insurance companies. That's all they do. Condominiums and HOAs. If you are not having your insurance agent look at the HOA before closing, you're really creating a huge problem for your person buying that condominium. The HOAs, as many of you know, are established to structure the insurance. And just like every consumer out there, everyone doesn't want to pay a lot for insurance. So a lot of times when these HOAs get together and they go out to bid for insurance, they want to get the cheapest price, and that usually ends up affecting the individual that has a claim. There is a loss assessment endorsement that you can put on your condominium that says we'll pay an additional $50,000 if the property isn't insured properly. And so there's things that your insurance professional can do to help mitigate those things. But what the insurance requirements, say, and why you should give that insurance agent says, okay, this is how we're insuring this particular property. Most of them are the stud in, stud out. Stud out, the HOA, condominium association will cover. Stud in is the responsibility of the occupant. I have seen in recent years all kinds of things and changes that are made on that insurance requirement. So make sure you get a copy of it. It's usually on page 7, it says insurance requirements, and give that insurance agent opportunity to review that before closing to make sure that they build the right condominium coverage for those individuals. Vacant homes for sales. Most properties or home insurance properties have an exclusion that after 30, 60, or 90 days, the home is no longer insured because it is not being occupied. And this, in 2008, when we had a bunch of homes that were unoccupied, people were just walking away, the vacant homeowner policies were significantly more expensive than the traditional homeowner policies, but they were able to capture some underwriting data during that time and saw that, as long as you had somebody managing the premises, keeping temperatures on, coming in every now and then to make sure someone wasn't squatting or occupying the home illegally, the rates have gone down. So the difference between an unoccupied home and a home that is occupied, the premium difference isn't that much. So if you're representing someone who's selling the home, and you know that that home's going to be unoccupied for a period of time or has been unoccupied for a period of time, it's been on the market for more than 30, 60, 90 days, check with the existing homeowner policy to see if that exclusion applies. Landlord policies, I see it all the time. Loss of income is usually not at what they're collecting for that rent. And the loss of income, what it does is, should there be a loss, it will pay the loss of income that the landlord will receive while the property is occupied. It has to be covered cause of loss. So not finding a renter is not a covered cause of loss, but a fire, if it was occur, they can pay that. There's also an endorsement that I would write this one down. Try to secure policies that have what's called actual loss sustained. And I'll just give you a short story and we'll wrap this up. During Alameda, fire down here, we saw individuals that were out of their homes, and there's still a few to this day are still waiting for that home to get rebuilt because of limited materials, demand surges, not enough coverage, whatnot. What actual loss sustained says is that it's a bottomless bank account to cover that actual loss sustained being outside the home. You can add that to the loss of income provision. So whatever the duration or period, most policies are limited to 12 months or 24 months, or worse, they're limited to a dollar amount. And when they run out, they're out. Whether the home owner's in the home or not, they don't have that coverage. You can get what's called actual loss sustained, which means that no matter what that period of time or the amount paid or amount missed, they'll be made full and whole. Let me just look here real quick. I think time, Kevin, tell me, I know we started a little bit late there. I'm going to show you real quickly. This is a postcard that James and Ann can provide you. These are just some of the main touching points. And again, as you take some takeaways, there's multiple factors. We talked about insurance scoring. We talked about location. We talked about clue reports. We talked about age of home. We talked about ownership. One of those, probably the biggest one we see right now is probably clue and the wildfire location being the biggest ones right now. But one by itself doesn't crash a closing. But when we have multiple things like location is rural, they've got a couple claims, the insurance score was low, you're probably not going to get that insurance binder to be under the debt to income ratio and everything you need to close. And you may not now, because of the current market, even be able to find insurance. So this little checklist is available for you to reference for you as well. And so we'll send that out maybe to Kevin in an email so you guys can have access. James, Ann, any closing comments that you'd like to talk about?
I think we got it.
Excellent. Well, guys, thank you for your time. I know that, like Kevin said, the weather's beautiful today, and the fact you signed up for an insurance CE. We've all seen Groundhog Day. We know Ned Ryerson's a real thing. Thank you for just being kind and attentive and listening to the presentation. And again, anyone, any insurance broker out there, you can reach out to. They can help you pre-qualify the insurance, just like you have them pre-qualify for the loan.
Hey, Scott, we have one person with their hand raised.
Yeah, you
Claire,
bet.
I'm asking you to unmute if you want to ask your question, or maybe it was. maybe she didn't raise her hand. Maybe she accidentally raised her hand. But you can unmute Claire and go ahead and speak if you want. Nope. Okay. We have two, actually, everyone's just in the comments saying thank you and great class. So again, I want to also thank you, all three of you, for taking time today to do this, and very informative. Really appreciate it. And for everyone that's still on the call, we will have certificates to you no later than Tuesday next week. They'll get emailed out to you. If you don't have them by Tuesday, give us a call on Wednesday. And for some reason, we may have had something wrong with your email. So with that, thank you again. Appreciate it. And everyone have a great rest of your week.
Thanks.
Thank
Nice to
you.
meet you all.
everyone.
Have a good day. Bye-bye.
Bye, everyone.